In this overview, we walk through the Generalized Protective Momentum Strategy. This is a quantitative model that incorporates momentum, correlation analysis, multiple asset classes, and seeks to manage risk and limit drawdowns over time. The key fundamental investing insight behind the model is this. By investing in a diversified set of asset classes that have both strong momentum and limited correlation with each other, this can produce superior risk-adjusted performance compared to a standard 60-40 portfolio. At a high level, the strategy invests in the assets with the best combination of momentum and lack of correlation with each other among 12 different asset classes. It invests in the 6 asset classes with the highest score using a system that combines both momentum and correlation, and it will move aggressively to a cash protection stance when the asset classes in the selection universe enter a downtrend. The source and the evidence behind the model. This model builds off the protective asset allocation strategy, which was tested in academic research from 1970 to 2015. The protective asset allocation model showed better raw and risk-adjusted performance versus the market and the standard 60-40 portfolio with significantly less risk in the backtest. The investment thesis behind the model is this. Using momentum and focusing on limited correlation among portfolio holdings can help investors boost risk-adjusted returns and help protect from major declines compared to a static asset allocation strategy. Okay, now let's look at how the generalized protective momentum strategy is actually built and the criteria that go into the portfolio's construction. To start off, as I mentioned, the strategy uses the protective asset allocation model as the basis. First, the selection universe selects among 12 different asset classes. So this model can choose from buying the S&P 500, the Russell 2000, the NASDAQ 100, European equities, Japanese equities, emerging market equities, long-term treasuries, high-yield bonds, corporate bonds, commodities, gold, and real estate. From there, it determines which of the 6 asset classes are performing best and which have the least amount of correlation with each other. So this model uses a 12-month look-back momentum criteria to identify those asset classes that have the best relative price performance. From there, it incorporates correlation analysis to hold those asset classes that are exhibiting the most momentum and the ones that are less correlated with each other. From there, the portfolio is rebalanced on a monthly basis. So this portfolio is reviewed and changed monthly. Positions are changed based on both the momentum and the correlation with each other. And lastly, this portfolio has the ability to flex in and out of the market or in and out of risk assets based on the relative momentum of the group. So when 6 or more asset classes are exhibiting negative momentum, this model has the ability to move to a 100% crash protection position. Investors looking for an alternative to a 60-40 portfolio that has historically shown strong performance and far less risk than a static 60-40 portfolio may want to consider generalized protective momentum as part of their investment strategy.